Hi, I'm Cami with Lyng Real Estate, here today with my colleague Nerissa, Wong-VanHaren, and she's another wonderful agent here with me at Lyng.
Thanks for having me, Cami. I'm excited to talk today about a lesser known tax strategy which real estate investors can use to drastically reduce their tax liability thanks to something called bonus depreciation and cost segregation.
Do you have any personal experience with this tax strategy?
I do. I have been managing my own rental real estate for years now, and I've recently found out about this amazing way to save my husband and me $47,000 in taxes this year alone.
Okay, please tell me more.
It's important to know that this only applies to real estate investment properties, meaning not your primary residence. But it could possibly apply to your vacation home if you rent it for a certain amount of time. Now, if you purchased your property in 2021 or earlier, or after January 2025, you can take advantage of 100% bonus depreciation to save on your current tax return. If you purchased an investment property in 2022, 23, or 24, it might still be worthwhile for you to look into this, but it is a little more complicated.
Okay, so let's clarify. You call this strategy bonus depreciation. What is depreciation?
Great question. Depreciation is a type of tax deduction. It accounts for the fact that over time your asset, be it a car or a building, will get older and it will depreciate or lose value over time.
Okay, I believe that one of the advantages of owning a rental property is that you can depreciate or basically deduct a certain amount of money every year from any income you earn, reducing your tax liability. Is that correct?
Yeah, definitely. Most people or their accountants use the traditional method, which is called straight line depreciation, because it is simple and it's free. You just take the value of the building when you purchased it, divide it by 27.5 years, and deduct that amount every year from your taxable income. But that method of depreciation is far inferior to doing a cost segregation study, which can easily double your tax savings over the long term.
So what exactly is a cost segregation study?
I'm glad you asked. It's when you hire a licensed company to do a detailed analysis of your building and create an accounting of every window, door, and fixture in it. That value is usually much higher than the value used in straight line depreciation. And once you have that report, which will cost you about $2,000, this is mine, you can use it when filing your taxes to save yourself a lot of money. Look, for example, using straight line depreciation, I would only be able to deduct about $18,500 a year for 27 years from my taxable income. Whereas using bonus depreciation with cost segregation, I am able to deduct $135,000 from my taxable income in the first year alone, and another $95,000 over the next 4 years, for a total of $230,000 in depreciation just in the first 5 years. Now, if I were in the 35% tax bracket, then 35% of 135 is $47,000 that I would save in taxes in the first year alone.
That's incredible.
It's definitely worth spending the $2,000 to get that kind of savings. And I can use that $45,000 to invest in something else right now. This whole process can be a little complicated and has a lot of details, so I would be happy to talk to anyone interested in finding out more. Give me a call, shoot me an email, and I'm happy to help.
And thank you for sharing this valuable information, Nerissa. Anyone buying an investment property should definitely take advantage of this strategy.
I agree. And if you haven't previously considered investing in real estate, this is just one of the many reasons why you should think again. Also, if you have been holding on to an investment property for 15, 20-something years, then it might really benefit you to do a tax-deferred 1031 exchange and purchase a new property so that you can take advantage of these huge tax savings.
Yes, and we can talk about 1031 exchanges in our very next episode. So until next time, this is Cami Bashir and Nerissa Wong-VanHaren with Lyng Real Estate. Bye.